What if I told you that the companies quietly making millionaires are the ones nobody brags about at parties? Not flashy tech startups, not meme stocks, not crypto coins with dog logos. I'm talking about companies that sell toothpaste, trash bags, industrial screws, insurance, railroad services. Boring? Yes. Profitable? Extremely. Today, I'm going to show you why boring companies often outperform exciting ones, and how beginner investors can use this strategy to build real wealth. Let's get into it. Why boring companies win. When most beginners start investing, they look for excitement. They want the next Tesla. They want rapid growth. They want headlines. But historically, steady, predictable businesses often outperform hype. Why? Because boring companies usually have predictable cash flow, essential products, strong pricing power, loyal customers, dividends, and most importantly, they survive recessions. During economic downturns, people still brush their teeth. They still buy groceries. They still pay insurance. That stability compounds over decades. And compounding is how millionaires are quietly made. Example 1, Procter & Gamble. Let's start with one of the most boring giants out there, Procter & Gamble. They make things like Tide, Gillette, Pampers, Crest. Nobody gets excited about laundry detergent. But here's what's interesting. P&G has paid dividends for over 100 years. It has increased its dividend for decades straight. If someone invested consistently in P&G 20 to 30 years ago and reinvested dividends, they built serious wealth without drama. No viral headlines. No hype cycles. Just steady growth. That's boring power. Example 2, waste management. Now let's talk trash. Literally. Waste management picks up garbage. That's it. But think about it. Garbage collection is essential. Cities can't function without it. It's expensive to build landfill infrastructure. It's heavily regulated. It's hard for competitors to enter. That creates something powerful, a moat. Waste management has quietly grown revenue and dividends for decades. It's not sexy, but it's consistent. And consistency compounds. Example 3, Johnson & Johnson. Healthcare is another boring but powerful sector. Johnson & Johnson sells medical devices, pharmaceuticals, and consumer health products. People don't stop needing medicine during recessions. Like P&G, J&J is known for being a long-term dividend payer. Now, this doesn't mean it's risk-free. Every company has risks. But the business model is durable. Durability is what beginner investors should care about most. The hidden millionaire formula. Here's the secret. Boring companies help you avoid emotional investing. Exciting stocks tempt you to panic sell, chase hype, time the market, trade too often. Boring companies encourage long-term thinking, dividend reinvestment, patience, compounding. Let's say you invest $500 per month in stable, dividend-paying companies and earn an average of 8 to 10% annually. Over 30 years, you're potentially looking at over $1 million. Not because you got lucky, but because you stayed consistent. This is exactly the type of strategy often recommended by legendary investors like Warren Buffett. Buffett famously invests in understandable, cash-generating businesses. In fact, one of his largest holdings is, example 4, Coca-Cola. It's soda, that's the business. But it has global brand dominance, massive distribution, and decades of dividend growth. Boring doesn't mean small. Boring doesn't mean slow. Boring means dependable. How beginners can apply this. If you're just starting out, here's how to apply this strategy. 1. Look for essential products. Ask, will people need this 10 years from now? Food. Utilities. Healthcare. Waste. Insurance. 2. Check dividend history. Long histories of dividend payments often signal financial strength. 3. Focus on profitability. Are they consistently making money? 4. Avoid hype. If everyone on social media is screaming about it, pause. Wealth is usually built quietly. You can also use low-cost index funds that track the broader market. Many of them are filled with these same boring companies. For most beginners, simple beats complex. Important reality check. Now let's be clear. No stock is guaranteed. Markets go up and down. Even boring companies can struggle. This isn't about getting rich quick. It's about getting rich slowly. And slowly is underrated. If you found this helpful, subscribe for more beginner-friendly investing breakdowns. Remember, excitement is fun. Boring is profitable. And consistency builds wealth. See you in the next one.